Yeah.
Hi, can I check that I'm visible and audible? I apologize for the him. Yes, we need to acknowledge that no matter how many people love him and want to be like him, not everyone will be Warren Buffett. There's only a few Warren Buffetts in our. There's only a few people like Warren Buffett in our society, and it will stay that way. Thus, we do not support retail investors. So first, let's look at the characterization for today's debate. When we first look at retail investors, we see that they don't specialize in investing, so they lack the experience and knowledge in investing. In that sense, because they lack the experience and knowledge, they will not necessarily know when is the best time to invest, when is the best time to stop investing. And apart from that, they have a tendency to make short-term decisions based on unreliable justifications, such as hearsays. So I'm sure all of you guys have been on Instagram, and there's always these advertisements that say, listen to this is how you invest. There are many of these type of advertisements on all types of social media, and not all of them are correct. Yet these people do not understand it, and thus will listen to what is happening there and will take actions based on that. When we look at institutional investors, we see that they're more experienced and professional, and thus are able to make way more money. Now, when we look at secondary source of incomes, we see that it often means people with a day job taking up investing with additional money that they have left over. So basically the money that they would otherwise have saved. And no, the secondary does not say anything about the amount they actually invest into or earn from retail investing. They may earn from stocks or than the salary on one specific month, but the stock still remains as a secondary income source if they do not rely for their day-to-day matters, such as, for example, they do not rely on that income, where if that income is removed, they will not starve and they will not suffer from the financial impacts. So now let's look at the counterfactual for today's debate. We believe that for those with investing as your primary income, you have a high likelihood of going through institutional investing, and like what we characterized earlier on, it gives you the most amount of money, and thus we support it. Meanwhile, for those who are treating investing as a secondary income, we do not support it. And we will prove later on why it will cause you much harms. For example, you losing money and you not having savings. The burden of proof for opposition is that they have to prove that retail investing is not only highly accessible to the individual layman, which includes both the lawyer, which is okay, and also the lower middle class blue-collar worker who does not spend his time on, for example, Coursera, learning about economics. Opposition also needs to prove that retail investing is highly accessible to those with an unstable source of income, because stability is way more important than one-time gains to the average individual, and they need to prove that investing is also a stable source of income, not only for those with stable incomes, but those without. They also need to prove that along the way, that there's no unnecessary pressure forcing them to take a short-term and rash decision, which intuitively would not be the case, because there will always be signs that will make you want to have short-term and rash decisions. So the yardstick for today's debate is that whichever side ensures that these individuals gain stability in finance will win the debate. Moving on to my first substantive on how there will be many occurrences of panic investing. So first, we need to understand that retail investors, they always have unrealistic expectations. You put your money in Tesla and you expect it to grow big. Even if it's a positive upwards trend, but it is not as fast as you expect it to be, you will think that you are failing, and thus will change your style of approaching investing, and will go invest in other more unstable stock options that might not necessarily give you the safest yield. And when we look and continue looking at retail investors, we see that they're inexperienced and they have not studied for it, most of them, and they have not done investing professionally, and thus they invest not through their mind, they invest through their hearts. When they think, oh, maybe I can make a good profit out of that, they will invest. They will not look at the graphs and look at the trends and see, oh, maybe this is a good time of investment. That will not happen. And the fact is that we need to acknowledge that for many of these retail investors, they are not very old, and thus they do not have a lot of time and money to make it big. Many of them, actually all of them, from what the motion is saying, is that all of them have day jobs, and thus they do not have the time or money to make it big, especially the time because they have that day job to attend to. So when we look at retail investing, we see that firstly, it is over glorified because we have seen many success stories. Going back to Warren Buffett, we see that he made it big because of investing. Yet that is not necessarily the case, and it is only these few success stories that make it to the headlines. And those thousands and millions of people who failed in investing did not manage to make it to the headlines and did not manage to tell other people about their experiences. We also need to acknowledge that retail investing, many of which are in different time zones. For example, I am in Singapore, I want to invest in a US stock. I will need to adhere to the US time zones, and thus I will not necessarily have a lot of time to do it because it will be at night. So now, we also need to acknowledge the fact that the trend right now is that most retail investors do not make money. 70 to 80% of investors do not profit from it, and instead they either make it even or they actually lose money and lose profit. So now moving on to the mechanization, we see that because a lot of people they do not have the criteria as mentioned from a characterization, they will not always succeed because we need to acknowledge that investing takes money, time, and experience. And not only that, it also takes luck, in which not all of them will have luck. And when they do not get a good sign, they will actually turn to other more drastic measures, which is what's happening in the real world as well. Because for many of people, well, let's just take Bitcoin, for example. It was at a low at one point, and not everyone will be like, oh, this is a smart decision to invest. We will invest in that. Not a lot of people did that. The reason why Bitcoin is so famous is because firstly, it has a high yield, but secondly, not everyone got a very high yield. And instead, many of them lost money. So that is what is the side of the picture that we do not see. Yes, ma'am. Yes, sir, ma'am. Sorry.
When you say that investing takes time and also experience, but these institutional investors, they also start from zero experience. So what is your engagement towards that?
We need to see the difference between institutional investors and retail investing, in which I proved to you already. But the fact is that for these institutional investors, firstly, they have people discussing with them and actually helping them to see which are the best trends to follow. That's what with the institutionalized investing, because one of the main characteristics of it will be that there are private investors that help you. But secondly, the fact is that for many of these institutionalized investors, you put in a lot of money. And before you put in a lot of money, you will, of course, you will learn about it. And when you have that much amount of money, you have the time to study it as well. Many of them, they will go look at the trends, they will look at lessons, and they will talk to famous people such as Warren Buffett to learn about it. So now we see that they will, for many of these retail investors, they will invest in the ones that have high risk, high reward, because that is where all the success stories comes from. For example, I will not say, oh, I will invest in the S&P 500 because there is either a slow upwards trend or a slow downwards trend. Instead, I will invest in one of those small companies or those with a high risk, high reward, such as Lily, because that is where I can get the amount of money that I want. But we need to acknowledge that there's a high risk as well. Thus, the outcome is that many people will lose money, which is a heavy detriment to the people because they are unable to recover from it. Thus, so proud to propose.
Thank you very much, First Prop, for that speech. I'll invite the first opposition to open the case of the opposition bench. First opposition.
Hi. Hello, is this audible?
Yes, I can hear you clearly.
Excuse me,
Alright.
Chair. Could we request that the speaker speak a bit louder? It's quite hard to hear from our side.
Our first opposition. Prop says they can't hear you clearly. Or can you speak louder?
Hi, is this audible now? If I speak at this
Can you
volume?
read
yeah,
the
sure.
motion?
What's the motion? This House opposes the trend of individuals using retail investing as a secondary source of income.
Oh yeah, sure. That's audible. Yeah, that's fine.
Okay, easy.
Okay.
Can we leave time?
Beginning my speech in 3, 2, 1. Don't put everyone's eggs in one basket, because the moment an elephant comes in and steps on them is the moment that everyone dies. The thing that they're missing under their side is the fact that when you put all of everyone's money into one place, it's prone to misuse and it's prone to falling. We say that like under our side, even though there's a trend that's going into individual investment, under their side there has to exist a trend that pushes away from this. That is, say, a counterfactual that they have never failed to mechanize, or that they have failed to mechanize. What are you going to see under this speech? Firstly, an argument on control and why that's principally important in this debate, and secondly, on accessibility, which answers all of their questions or burdens on has to be accessible to the middle class or accessible to the poor. We say that like those are the arguments we're going to follow forward in this speech. But before that, one point of extraneous rebuttal, they told you that they want stability under their side, and the reason why they can't get us under our side because people are prone to make uninformed choices when they do it individually. We say that we want to flip this argument. We say that the fact that you post all of your thinking onto these institutions to make all their financial decisions for you is the moment that you don't make informed choices. The fact that they advertise their own institutions as a method of getting money fast, of it being a successful side hustle, is the moment that you
Point of information, sir.
brain power all of your brain power into these institutions, and it makes you more prone to making bad choices. We're going to get to I'm going to go into more depth in the argument on control. Comparatively, notice that under our side, trends come with engagement, and with engagement comes with a larger platform for people to actually educate and advertise. This means that education is exclusive under our side, because under their side, it's not education, it's advertising, and it's advertising for the institutions that want you to buy into them without thinking twice. However, secondly, they told you that people simply don't profit off of individual investment. There is no analysis to why this trend exists in the first place. Then, if this was the case, intuitively, the moment a trend exists is because there is like a benefit you can reap for it, and the fact that it's glorified is because a lot of people like proliferate ideas that, oh, I succeeded from this, therefore you can as well. We say that like at best, like there are a random number of 70%. Like I don't know where that comes from. Like logically speaking, intuitively, if a trend exists, then there are precedents of success. However, like secondly, even if the people are more prone to fail, notice that the choice exists under our side. Because under their side, the
Point
fact
of
that like no
information, sir.
doing this individual investment later means that you're put off from actually doing so, because everyone glorifies institutional investment as the sole method of investment, and this is the right way to do it. Under their side, you can't invest personally because there are narratives that constrain you against it. I'll take your POI.
Would your side remove the high minimum investment for hedge funds, making hedge funds accessible to all individual average investors?
We say that our side doesn't want hedge funds because hedge funds are limited to institutional investment. We say that individual investment doesn't require this, and I'm going to get to this in my second argument actually on accessibility. The first argument then is on control, because notice that under their side there exists a counterfactual narrative that it's not good to do this and you shouldn't do it because it's dumb. You get more agency under our side, and that is the thesis of this argument. Why is choice better under our side? One, you simply get more optionality. That's to say that when a trend exists, there exist businesses or people who want to capitalize on this trend and accommodate for it. This means that you get more creation, for example, websites that give you individual trading. And we think that this, simply on the basis of optionality, means that we get better choice. However, secondly, that it's easier to pull off under our side. That is to say that when you sign up for institutional investments, you need to sign contracts for trust, for example, stuff like that. You can't just pull out willy-nilly as you can as an individual investor, but you make the choices yourself under our side. However, lastly, is that the importance of choice is that you're able to make an informed choice. That is to say that under comparative, the people that invest in institutional investments are people who end up outsourcing all the responsibility of thinking about what a good investment policy is to the people of these institutions. Under our side, you have to make your own choices. That is to say, you're more incentivized to get educated, and it means that you're more financially literate under our side. However, furthermore, we say that simply because people are more incentivized to learn, you get more platforms or more sources in order to actually get educated. We mean to get more nuanced information under our side. The second point on why it's true you get more control is of self-accountability, that you are directly responsible for your own actions and your own losses. Principally, that is to say something as dear as money, especially for the middle class, who they characterize to be work themselves to the bone to actually get it, shouldn't be thrown to institutions to be responsible for whether or not the money goes up or goes down. The impact then is that there are less risky individual investments simply because these people are more closer
Bunch
to their
of
money.
information, sir.
And these people have more control over what they want to invest in. The importance of this argument is that one, agency is simply principally good. We say that the government does support self-determination and support that the government does it, then we should do it too. However, secondly, that optionality is simply better. Let's just say that we provide the people with more choices, and that goes and turns itself into agency. However, the second point of importance is that their side is prone to misuse. That is to say that you put all your money into an actor that may engage in risky strategies. That is, for example, shorting, for example.
Point of information,
like
sir.
the principle relevant of this argument later is that investors don't consent to this kind of use. That institutions characteristically don't want to advertise themselves as being risky, therefore they advertise themselves as being safe or whatever. I said that means that once you invest your money into these institutions and they use it for risky strategies, this is not something you consent to, and it's principally abhorrent on that basis. This looks like, for example, when Jinyi use all their pension funds into the mafia, we say that this is not something that people consent to, and this is not something that people want under our side. However, thirdly, is that they prioritize the rich. That is to say that they cater towards the people that give them the most returns. So the people on the lower rungs of society, they don't cater to you. That is to say, it justifies, it internally justifies practices of risky business strategies because they know that you have they're less likely to complain when you're rich. Let's say it doesn't cater towards you as a poor person who end up losing more than a rich person. It would also buys into the illusion of consent that exists exclusively under institutional investment. The exclusivity of this argument is quite intuitive. You simply get more control under our side. I'll take the second POI, sure.
Or in 2011, right, individual investors were all quote unquote educated, aka incentivized by Lehman Brothers to invest in subprime mortgage stocks. This counters your point that when individuals have to make their own decisions, they're much more likely to educate themselves before making that decision.
I think you're living in a world pre-social media, right? You're living in the past where information isn't as accessible, and we see that under our side, we do get this kind of information. This is something that is a very cherry-picked example. The second argument on accessibility. Notice that institutional investments have a really high economic barrier. That's to say that the hedge funds require you to have a portfolio for institutions to trust you to make these kinds of investments, and it's so that they have a very high service fee, that the loss margins you have to have in order to go into this is much higher because you're outsourcing your income to institutions. That's to say you have to have a large income and a large loss margin to begin with. However, fourthly, you need access to certain circles. That is to say you need to know the actual process of hedge funding, and this is not something that is accessible to the poor, but a trend that actually accentuates this kind of thing. So why is it true that we get more accessibility? One, the trend will self-perpetuate. That's to say that when you friends in social media circles will tell other people that this is something that's good, and it's going to bring down exclusionary narratives under their side, which push people away from individual investment. However, secondly, that you get a lower startup cost under our side. The risk is more flexible under our side simply because there's a lower startup cost. However, thirdly, because of education, because of more financial literacy that exists under our side previously analyzed, you get it's simply more accessible because people know how to actually do it exclusively under our side. The importance of this was that one, brings down the exclusionary monopoly of the rich. Secondly, it pushes these institutions to be better because people are moving away and they need to better or bring more benefits to the table. However, thirdly, it validates liberty. That is to say, it brings down the toxic rhetoric of institutions, that this is the only way to get rich under our side. Any other individual investment is not a good idea. And fourthly, it answers all their burdens on accessibility. And for those reasons, we're proud to oppose.
Thank you very much, First Opposition, for that speech. I'll invite the second prop to proceed with the case of side proposition.
Hello, very good evening. May I check if I am clearly visible and audible?
Yes, to both.
All right, that's wonderful. Give me a second while I pull out my materials. Retail investing is just like my romantic life. I may think I'll get a lot of gains from it and I'll eventually pull my crush. But at the end of the day, I do not manage to, and I make a loss. But I still keep coming for more. That is the reality that faces most of retail investors in their own regard when it comes to retail investing. And this is where we'll start off with a few of our rebuttals for today. Mainly, the main idea that the side of opposition was trying to perpetuate was the idea of financial literacy that they get on their side. Let's take this down in a few layers, shall we? First and foremost, the idea of education is not a caveat that you have. It's not a magical solution that, boom, once you have it, you're going to solve everything. Why? Because if educational campaigns were to work, racism wouldn't exist today. Because by your logic, every single educational campaign should have a 100% success rate, or at the very least, even if we're being generous, a 50% success rate. That's not happening when it comes to things like racism, sexism, xenophobia, etc. No matter how much countries try to integrate or assimilate individuals into the population, this still exists. So this shows that education in and of itself is not something that we can solve as a whole as a magic bullet. Furthermore, because this is the economy and it has to do with money and it's a very volatile market where things are changing literally every single second, it makes it even more difficult for these educational campaigns, so to speak, to hold up. It's not like an examination where I can memorize my biology and it will come out in the exam and I can regurgitate it. That's not how the financial world works. And second, we bring this up to you in our point of information, but it seems like their side is just shirking it away by saying it's cherry picking. The Lehman Brothers example. Let's impact this so we can show you the exact harm that's brought by these companies making these changes in and of itself. Number one, when the Lehman Brothers scam in 2011 had this idea that stocks will make it big. Bankers in 2011 will make it big. And they think that therefore these individuals think that stocks will increase their home values. And these Lehman Brothers essentially got a lot of poor and middle class people to invest because this was marketed as an accessible layman people kind of stock. Many people fell in because they felt that, there was a pressure to keep up the demand, and therefore they kept taking much more mortgages because they felt that they could pay it back eventually when they couldn't pay them back. And therefore this led to essential kinds of subprime mortgages. And when housing values essentially spiked as predicted, now people can't afford these mortgages, default their loans, bonds are gone, investors, these Lehman Brothers couldn't pay their investors' monies are gone, huge risk that essentially led to this whole collapse and scare at that time. Why is this so crucial? Because it completely refutes the idea that these companies are teaching these people how to learn finance. It's not the case at all because these companies at the end of the day are profit-making companies. Their goal is not to teach me how finance and economy works. Their goal is to teach me. Their goal is to essentially get me to invest as much as I can and as much as possible. Now, we take a look at another idea about the institutional investing model. Now, it seems like they didn't really listen to our case and they felt that it was something that we want because they talked a lot about institutional investing, which we didn't even really highlight in our case at all. Because what we're saying is, if you already rely on your day job for income and investing is just a secondary income, we would just prefer you to save up and not invest at all. And even if our alternative was institutional investing, let's be charitable here, the limited nature of it means that institutional investors are quite literally often the professionals. And this is why, despite often having the highest risk, they mostly bring the most consistent gains as well. AKA, that's why we're fine with those investors carrying on. There's a very big difference between that and retail investing, and that's something that they haven't dealt with properly at all in mechanization. Now, another thing is we just need to make it clear, baseline, people do not profit off glorification by companies who want these people to invest. And the second idea is that these people still invest, right? As they explain in the mechanism, social media circles. Now, who's to say that this is necessarily a good thing? Because who told you that your neighbor who invests in these stocks, who told you that your best friend who invests in these stocks was a financial expert? Who told you that this person has a financial degree from Harvard? Who tells you that they know essentially what they're doing and is completely risk-free at all times? And even if at the end of the day, we agree that there is a certain element of risk to it, we tell you that this risk is something that cannot be disregarded because more than half, in fact, I'm not sure of the exact value, I think it's 80 to 90% of these retail investors usually lose money. But why do they come back? Tying back to my relationship example, the glimmer of hope still exists. And that is always perpetuated by these social media circles and companies who want to profit off these individuals. The mechanism itself is inherently flawed to make profit. Their mechanism does not work at all. So when we weigh it on a grand scheme of things, we essentially told you in our first speaker about how there'll be many occurrences of panic investing, because this is essentially what will happen. Think of it, right? When there's a huge profit in a certain stock, for example, these retail investors were just day-to-day workers. Put yourself in the day-to-day worker, right? You're not very good at finance. You didn't graduate from financial school. You're just a day-to-day worker. And therefore, you're doing this as a part-time because you feel that it will compound your interest rather than just saving your money. Are you really sure that you're going to be confident in what you do and not essentially panic invest and go with the flow? If you see many people going in, wouldn't you usually follow the crowd? And that's why so many of these retail investors fail. Because at the end of the day, these investors always have the same traits that they tend to, number one, is that they have unrealistic expectations. Like, for example, if you put your money in Tesla, you will expect it to grow big, but you don't know when it will flop. And number two is that if these stocks essentially start to fail, you will now withdraw all of these the kind of investment that you've made, and therefore, as a result, this essentially results in a scenario where these people are not going to be making the wins that they thought they would. With that being said, let's impact our first two substantives even more by dealing with the actors that's harmed by this most: poor people and poor people and individuals with lower income. Why? Let's deal with this first. Poor people. Few characteristics about them. One, they lack a financial safety net. Investing itself inherently carries a risk, and losses in the market can have a devastating impact on their already limited resources. Because think of it, you're dealing with individuals who barely have enough money to have a roof over their head and a meal on the table 3 times a day. These individuals are people who are not your day-to-day average kind of person living in a first world country where you can have a lot of money to kind of even risk some of it to invest. These people have very limited resources, and a single bad investment decision could wipe out their emergency savings for them. Two, they don't have as much education. No matter what we say, these individuals are more vulnerable to misinformation, as we saw in the Lehman case. And now, because these people recognize that they never will climb up the poverty ladder unless via their regular day-to-day jobs, they have even more pressure on them. There's more societal stigma on them. They're more encouraged to do something drastic by finding an alternative source of income, which unfortunately becomes retail investing, which we do not encourage. And companies also, they want to prey on this by essentially promising these quick returns, which what happened in Lehman Brothers. So what's the effect of this? The effect of this is that these people make uninformed decisions, lose money that they could have done saving it or helping it or essentially investing it into their own business, right? In their home business where they are essentially selling more of their goods or whatnot. They could have done this, but they're not. So the significance of this is that it therefore even spirals them further into this poverty cycle, making them unable to come up as well. Just like how I'll never be able to get a girlfriend. Thank you.
Thank you, second proposition, for that speech. I'll invite the second opposition to proceed with the case of the opposition bench.
Just checking that I'm audible and visible.
Yes, 2 points.
Okay, great. Time starts in 3, 2, and 1. 3 things I'm going to be doing today. 1, several pieces of reconstruction. 2, some refutation. And then finally, an extension on why you're going to get better returns on our side of the house and why it's going to be better for these people in the middle class when they are going to opt into retail trading. But before that, several pieces of reconstruction. I think largely we heard 2 large responses coming out from proposition, right? 1 is that if education works, there shouldn't be any kind of racism. And 2, their questionable intuition pump about the Lehman Brothers crashing the market in 2008. Firstly, then, on why education actually works. From the get-go, it's already extremely nonsensical that they try to draw a parallel with racism because clearly the problem is entirely disparate. It's so starkly disconnected because racism, the problem with it is because there's stereotypes and there's just this worldview that people are born with that they think that they're white supremacists, right? That they think that they're so much better than anyone else. And it's because it's these kinds of worldviews that you aren't able to change these kinds of things. But the difference is it's not that they're born with a different worldview. It's that they don't know what to do with the money, right? it's not that they already have like a wrong worldview. It's just that they don't have this kind of information. That means at the point at which you start giving them this information and you start telling them this is what you need to do, they're going to be able to capitalize on this information and they're going to be able to make better decisions. Later, I'll also talk about why financial literacy is so much more likely on our side, and I'll flag that later in the extension. But secondly, right, on the education point, right? Understand that financial literacy is not bulletproof. Education or information was never bulletproof in the first place. It's true that information asymmetry is probably still going to occur, but we would largely negate that when we say that there's going to be a lot of information coming in from things like online discourse or from things like people actually trying out the stock market for themselves. But then it's not bulletproof. Sure, people aren't going to be always profiteering like over their stocks and their tradings. Sure, but the thing is, they're going to be making smarter decisions so that as like an overarching thing, they're going to be making money, right? As a large thing, they're going to be making much more smarter decisions so that they're able to make sure that their money doesn't go to waste just there staying at the bank and falling to the traps of inflation. But secondly, right, they tell us that, oh, there's this huge example about the Lehman Brothers crashing in 2008, and that's why that's like bad, and this is like this intuition pump that they're trying to push since first. But thank you, Proposition, for giving such a good example to strengthen our side of the house from the subprime mortgage crisis that clearly is the epitome and the pitfall of institutional trading, right? This is a prime example when institutional trading at their prime, at their pinnacle, at the culmination of all their power, because people put so much money into it that they failed. That they got so happy with whatever money they got too risky, they played around with the market too much that it failed. It's because people, when they don't into retail investing and they go into like things like institutional trading, they strengthen the powers of these investment banks like the Lehman Brothers so that they keep crashing. They have so much capital, they have so much money because people don't have another option that they put their money into it, and then they're going to be extremely risky and they're going to cause the entire economy to crash. What is the comparative? On our side, we're going to diminish this power, right? Because we're telling you now that people are going to opt out of these things. They're going to go into things like retail investing. They're going to make their own decisions. That means we're going to force them to improve because now we get rid of their kind of power. They now no longer have the hold or the or are able to capitalize on the market because of like the amount of money that they control. Onto reputation. What does Proposition tell us? One, that like institutional traders have more experience and professionalism, and two, that there's going to be a lack of time and resources. Firstly, then on experience and professionalism, I'll take it a bit later. Before they start talking about experience and professionalism, first, they need to prove to us why these people can even opt into institutional trading in the first place. Because Rico already told you that one, like you have to pay for this professionalism and for this experience, right? Hedge fund managers are super expensive and most likely the average Joe cannot afford it. But secondly, this institution won't prioritize their needs anyway because you simply contribute less than the richer individuals that are putting in billions and billions of their money into BlackRock. But then, right, they also never prove to us why this professionalism and experience are going to be used in the first place for you, and why your money isn't just going to be used to like strengthen up their reserves or whatever to go ahead and cater to the rich people. You have to prove to us first why they can opt into institutional trading. Third, it's way too late. But right. Secondly, the reason why people cannot just store their money away in the bank, which is what they're trying to defend, right? It's simply because of the economic instability and fragility of the world today. That is to say that we're experiencing lots of inflation. We saw it in COVID, we saw it in 2008, we saw it in 1998, we saw it way before in 1980s in the Great Depression, in like the banking panic of 1937, etc. We saw all of these things happen, and we saw people's money getting eaten away due to things like inflation. That means by the time you reach 50 or 60, probably everything that you've made up in your 20s is going to be gone. That's why you cannot just save your money in the bank and like put it there. You actually have to invest so that you make like better returns on these kinds of things, because otherwise you're just going to lose it to time. All the work that you've been doing for your 20s is going to be lost. But before I move on to the second rebuttal on like time on researchers, sure. What's your BOI?
One side essentially hopes that these individuals can apply the limited financial literacy.
I'm sorry, I cannot hear you.
And
he can't hear you.
Oh, sorry. Your side essentially hopes that these people can apply the limited financial literacy knowledge to a volatile stock market and expect them to somehow gain returns.
That's exactly what we're trying to do, right? We're trying to get these people to get this financial literacy, and then they're going to be able to make these kinds of decisions. We'll explain later why financial literacy is going to be much more likely on our side. But then, time and resources. From the get-go, people who don't even have enough time and resources is not going to trade in the stock market anyways. They won't opt into it because they know that their primary income is not stable enough and that they don't even have enough money to ensure like they're going to be like safe like 5 years into the future. That's why they're not going to like opt into it if they simply can. But secondly, it's also unlikely that the people who are going to opt into it to be very risky, because after things like COVID, because after things like 28, like GFC, in these past years, these like kinds of events have already instilled a sense of fear and responsibility in these people, so that they make sure that when like the economy crashes again, or when like force majeures happen, their money is not going to be lost because they did things like stock and trading. The delta then is the group of the people with already stable incomes who just need these push from financial literacy to trade stocks strategically through this trend. Onto the extension as to why we're going to be making better returns. And firstly, we're going to talk about financial literacy, which is what I flagged in the beginning, right? Firstly, you're going to be making better returns because financial literacy is a byproduct of the retail investing trend. Because at the point at which retail investing becomes a common phenomenon, people are going to inadvertently be educated on the topic. Why is this necessarily true? True structural reasons. One, people will probably jump onto the bandwagon of retail investing and they're going to start investing. Then they're going to learn firsthand from their experience how to smartly invest. That is to say, if they were too risky in their first like small investments and they lose out, they're going to be smarter next time because they already learned in the first time that it's too risky and you shouldn't do that again. But secondly, online discourse in the form of YouTube videos, Reddit threads, etc., talking about people's own personal experiences with like stock trading is also going to largely increase when you have this trend, because now people are talking about it and it's becoming like a cultural phenomenon. Also, there's going to be things like masterclasses, YouTube videos on investing, etc. So people actually have the stock market know-how. And in the end, if this information were true, they're going to try it out anyways, right? And they're going to learn from this loss. Comparatively, without this trend occurring in the first place, people wouldn't opt into investing at all, because now they think that, oh, it's only for the rich people that they have like these hedge funds. It's not for me, not for the average Joe, so that I do not make any returns in the first place. But secondly, short-termism of institutional trading. Notice that institutional trading has strict deadlines. For insurance companies, for example, there are maturity dates to the bonds. They have to make sure that they have enough money to give back to the investors at the time of expiration. That necessarily means that they're going to be short-termists insofar as they have deadlines to meet and investors to satisfy. Comparatively, with you as your own arbiter of financial decisions, you're going to be able to wait out for market fluctuations and think about your long-term returns. Third, diversification. Institutional trading has certain packages and bureaucratic red tape tied to your own investments. So there's a set package. Comparatively, you diversify your risk and you choose what you want to risk. For those reasons, so proud to propose.
Thank you, Opposition 2, for that speech. I'll invite Prop 3 to conclude the substantive of proposition.
Hello, can I check that I am visible and audible? Can I check that I'm visible and audible now?
Yes to both.
Sorry, somebody's coughing here. I'm sorry if the camera quality is a bit grainy. Hope I've done the best I can. Also, my pronouns are he, him, and I would prefer verbal POIs, so just unmute yourself and talk. Yeah. The key to winning this debate, right, for opposition, lay in identifying a particular nuance in our counterfactual and then debating on that counterfactual. That's something the opposition has consistently refused to do throughout the entire debate. So we take it, right? We take it that they've turned down the opportunity to win this debate as a whole. In fact, they've given us as many minutes of engagement on our actual counterfactual as the amount of chances that the average poor Joe has of making it big with investing, aka 0. Let's talk about some policy attacks, first of all, right? The policy they come up and tell us is actually a very simple debate. Let's clarify the counterfactual on both sides. What we're telling you is that what we would rather is a world in which institutional investment remains, but remains as status quo. What that means is that institutional investment, as per status quo, right, is limited to the upper economic strata, to the Warren Buffett, to the investment banks, to the hedge fund investors, right? And we realize that that works, right? That works in status quo because they're constantly gaining more profit. They're constantly beating stock indexes. The reason being that more often people that invest in here take these as primary sources of income. In other words, often they themselves are professionals entrusting their money to professional investors. There's a reason why insurance banks still make it big. there's a reason how insurance banks still make money consistently. That's a system that we will keep, right? On the other end of the spectrum, our side is fine with these poor people then not getting access either to retail investment or institutional investment, right? We see that these people who would otherwise, if they have an investment option, use it poorly or face pressures that pressure them into making poor decisions, we would rather them, even in our worst case, right, we would rather them have not be able to invest at all. That is the real nuanced counterfactual that we've given you. That is a counterfactual that opposition has consistently ignored, because down the entire bench, throughout the entire debate, they've been running on the assumption that somehow on our side, poor people get access to institutional investment in the first place, which is not the case, right? So even from the very start, they've already failed to engage with us in the entirety. They've already lost the debate. In fact, let's talk a bit about their own counterfactual, right? Which is, oh, they'll have education. And on our response, we said something briefly about education is like probably one of the worst options when it comes to issues like this, including issues like racism, right? Education doesn't solve the problem all the time. Then they came out and they identified that as one of our main rebuttals and said that racism is completely different from investing. Well, it's really rich of them to then call us out for cherry picking, because this is exactly what I call cherry picking. But second of all, we've already, let's be charitable, accept this argument. We've already shown you how both are the same thing, right? Because when it both comes to the attitude towards race and the notions, perceptions towards investing, both a worldview, a perspective that's ingrained in people as a result of their upbringing, something that simply cannot be changed through education. So at the point at which the second speaker concedes that education doesn't work for racism, they've already conceded that their counterfactual false. Therefore, some strategic attacks, right? They've completely in their entirety dropped substantive 2 and substantive 3 or from outside. They've not engaged with how retail investing disincentivizes the average person to save, and the poorer economic strata feel pressure to make high-risk investment moves. Realize that our comparative arguments, right, the comparative we're running is they can retail invest versus they don't retail invest. It's not the comparative that the opposition is trying to give us, which impose on us, which is retail invest versus institutional investment. It's a very simple debate, actually, right? On our side, we'd rather those that can't invest, don't invest, and those that can invest, invest. On their side, those that can invest, still invest, but those that can't invest, still can invest, but then they just close their eyes and hope that they invest wisely. It's a very simple debate. Obviously, we've already won it from the very start. 2 clashes. 1, which side forces investors to make an informed decision? 2, which side minimizes risk for investors? One important reason why I arranged the clashes this way, why I put clash 1 the first, is because it's simply the most important, right? And it's also the clash that outside us as on-site or proposition I've been bringing to you. It's very important for investors to make an informed decision. This is quite intuitive because, well, it's their own money, and they should have control over it, both on the principle and practical level. That's out of the question, right? So let's actually get into the clash. Which side forces investors to make an informed decision? The substantive we gave on this clash was that there's a high likelihood of panic and rash investing. That's the substantive my first speaker raised to you. The responses were twofold. 1, that education happens on their side when individuals are forced to make their own decisions. Right. We've already told you how, 1, that this is already based on a false comparative of our side, or that individuals are somehow giving the money through institutional investment, which I already told you is not the case, right? On our status quo, we would rather them save up their money that they would otherwise invest. Okay, but let's take them at the best. Let's accept their imposed counterfactual of or even the poorest individuals invest in institutional investment. We see that their education mechanism simply falls because it's not happening to the lower economic strata, right? They literally don't have access to proper education because, well, surprise, surprise, that's why they're in the lower economic strata in the first place. Second, we've given you, this is a structural reason, right? Second, we've supported this structural reason with the example of Lehman Brothers, where the people educating the poor on how to invest is often the people selling them the investment options, trying to get them to buy into high-risk investments in the first place, feeding them with potentially misleading information that they can't cross-check on their own. Second, this minor point, they accuse us of having no analysis in the first speaker, right? They accuse us of having no analysis of why there even is an upward trend in the first place if in retail investment is so risky. But we've already shown you time and time again how there is a societal narrative of one, an over-glorified view of investing that everybody will make it big someday. And also two, my second speaker has brought in another mechanism for this. He's mechanized it by saying that there is an increased pressure, especially on the lower strata, to find an alternative income option to try to make it big. In other words, stock investing is the gamble that they are pressurized into making in order to that stems from a meritocratic ideology that try to pressures them into finding an alternative source of income to try to climb out that poverty ladder, because they think that in stock investing, one day they'll make it big, one day that will be the solution to bringing them out up the economic ladder. Second clash, which side minimizes risk for investors? And obviously, right, we gave you the sub 2 and 3. So, and technically they gave you no response, right? Because the only response is if you go through institutional investment, there's a much larger risk when everybody puts the money in the same place. But again, that assumes that our counterfactual is that everybody goes through institutional investment. But let's again take it charitably. But we've already shown you, right, risk is often small, much smaller when even if we force the poorer people to go institutional investment. Why? Because they're trusting the money with professional investors, right? The people who literally invest for a living, right? Surprise, surprise, the people that work on the New York Stock Exchange also invest as a 9-to-5 job. So they are the people that actually can and know how to invest. They're the people that wouldn't be swayed by emotions or hearsay. Second, most important technical mechanism, that the credibility of things like hedge funds often drags in market attention or other investors, boosting stock value artificially, making it much more likely for the stocks they invest in to be exactly the stocks that grow big. Very proud to propose.
Thank you very much, Prop 3, for that speech. I'll invite Op 3 to conclude the substantive of team opposition.
Hello, am I audible?
Yes.
Yes.
Okay. My PR preference is if you just unmute yourself, and I will be taking one. So you don't need to constantly like ask me for it because I'll be giving one. I'll start my speech in 3. Sorry, hold on. My timer's set. Start my speech in 3, 2, 1. Economy in our real world is asymmetric, right? Where the rich constantly get richer. But it somehow seems like opposition is literally ignorant towards the actual vulnerable actors who are the middle class of society, mind you. The people who are affected by this trend more are more likely to invest anyways. And we think that it's better for these people to invest in retail, right? For all the reasons we have stated in our previous speeches that I'll also rebut again in my classes. Their burden was also to defend how institutional trading is advertised towards like middle and lower class, which is funny because they actually gave you an example towards this, right? Because investing will exist either way on other sides of the house. So what we're arguing here is that we're saying that on our side it's better that they do it retail, right? And that they invest in like do retail investing, right? So what have they told you in their last speech, right? There were three main points to this. Firstly, I would like to clarify on how they said that our side has no urgency for regular people, right? We have stated you the urgency in 3 different reasons. Firstly, we have stated you about inflation, which was heavily rebutted under like our second speech. And secondly, is that simply we get more choice and autonomy, which is something that I'll explain in my classes later on. And lastly, that these people will get the money, right? The middle and the middle class live barely above their economic comfortability, meaning that more financial choice and extra money is often the only way for them to break free from these social status, right? So 2 main rebuttals then. Firstly, the funny thing about like the third speech from side proposition is that how they said that they prefer poor people not being able to invest, right? 2 questions from side opposition then. Firstly, how exactly do they make their economy better under their side then? Because we've told you that simply not doing anything they will lose their money to inflation, right? But secondly, are you forgetting that the motion states that their investing income is only their secondary income, right? Means that they are still able to put food on the table, right? Hence, when they say they have no access to institutional investing, they're wrong. They have a primary income, right? These actors, they still have a primary income, meaning that this institutional
Point of information, madam.
will still, sorry, later on, institutional investing will still like cater towards these middle class people. And secondly, then regarding education, because this is something that has been like widely discussed in this debate, right? What we've conceded to, if you listen properly, is that education not 100% working. That is extremely true, right? Which is obviously because nothing has an 100% success rate, right? But at the very least, we are actively trying to make people aware of economy, illiterate in economy, right? How they responded to this was, oh, side opposition education won't always work under their side. Okay, what's your alternative then? Because funds drawing from your inflation, because that's all I'm getting, right? Side opposition side proposition has literally given no alternative as to how people exactly are going to understand their economic status under their side better, which is something that's extremely important, right? Because these are middle class people, meaning that they're trying to achieve to get higher, like in the higher class of society. Before I go on, I'll take the POI.
Do you think that personal financial literacy is so powerful? Why do you think that in status quo, hedge funds even have a minimum investment, limit the investment to the top tier investors, primary source of income investors in the first place?
Okay. First of all, I would like to state that at the very least, right, hedge funds, they still target those who have income, right? So at the very least, what we're arguing here is not the lower class, because that is what your side is making it about, right? What your side is constantly talking about is like, oh, these people have no money, they're just like simply poor, right? But that is not the argument here, which is what I'm trying to argue, right? So basically, what I'm trying to say is that which side inevitably, right, the side that wins under this debate is like the side that protects the vulnerable actors the most, which is something that you're constantly ignoring under your side of the house, right? So at the very least, we've stated over and over again, even in our mechanization and our characterization on the first like op, we've stated about how these things work, right? So at the very least, right, under our side of the house, we're still protecting those in the middle class, like, and still giving them the choice and autonomy. So let's move on to the clashes then. What is the main clash that has been constantly discussed under this motion, right? Is that which side inevitably have like are profiting these actors more, especially the vulnerable ones, which is again the middle class of society, right? So what has proposition told you, right? They mainly told you about how like institutional investors are experienced, right? That was the very first thing to come out of like first prop. So why is this wrong? Firstly, even if they are experienced, that still doesn't guarantee the misuse of these funds, right? And secondly, but okay, let's say that these institutions are not inherently evil, right? Ops still cannot get a higher return or lower risk because institutional traders is still short term, right? Because they need to give back the money quickly to these investors, right? Meaning that they're still like way less effective under their side. And regarding about how like they prefer people like actors under their side to simply just not invest at all. I think we've like clearly rebutted against that under our second speech, which is something that they have not brought up yet under their third speaker, right? So I believe that they conceded to that argument anyways. So what have we told you, right? Firstly, we've told you about autonomy and control, right? When you're in control of your portfolio, you're able to align your own investments with your own financial goals. Why is this exclusive under our side? Obviously, you're the one holding the funds, right? You're not relying on another human being, because at the very least, they still also need to like argue as to why institutional investing will still cater towards those who are middle class and why it's bad, right? Which clearly they have not like discussed at all under this one, right? But secondly, then I want to talk about why this is important, right? Two reasonings. Firstly, this pushes individuals to learn more about their financial status, and this leads to better economy, right? Because when everyone collectively understands more about their economy, which is the ideal status of society, right? Whereby everyone is completely like acknowledging their like financial status and are completely aware of the decisions that they make in finance, then obviously that will lead to better economy, right? Because our society as a whole will grow better in terms of economy, because now people will understand what it truly stands for and will not just make risky decisions and just let other people like manage their funds and what to invest in, right? But secondly, then sense of ownership. Now, why exactly is this important, right? When sense of ownership happens under our side of the house, it leads to less anxiety, right? Because you're not blindly trusting some company, which is something that also like exists under side proposition, even if they're not like defending institutional investing, right? Because blind trust still happens under their side of the house, right? You're still trusting these banks anyways, right? So at the very least, under our side, we give them more autonomy, we give them more control, so that people are not only able to learn from their mistakes, like we concede to the fact that maybe, yes, people will more likely than not make mistakes in retail investing because maybe it's their first time or maybe they're not really knowledgeable regarding this, but we say that it's still okay because at the very least, people learn from it, right? People learn from mistakes. And secondly, people are subconsciously, they're not like dumb enough to like put all of their funds into investing, right? So what we've told you in the under mechanization of first prop is that these people will gradually invest, right? They will not just suddenly put all their life savings, which is the characterization brought up by second prop, by the way, which is highly unrealistic, right? But like they will gradually invest later on. And if they make mistakes on like the first few steps of investing, then that's fine. Everyone learns anyways. When it comes to institutional investing, they also make like investing mistakes, right? In the very first rounds of them starting to invest. So we say that it's fine as long as we give people the experience and the room and the chance to grow, which is something that cannot happen under side proposition, right? But then lastly, how do we actually protect these vulnerable actors, right? These middle class people. What we want to do is obviously to encourage them to learn about economy and truly understand their situation, right? When they when they understand, their situation will become more stable, better decisions overall, not just in investing, right? If that's what proposition wants to argue, then the burden that has not been fulfilled by such proposition is how exactly these people will learn if investing just simply does not exist under their sun, right? Because they're not defending that. So exactly why we're extremely proud to stand under side opposition. Thank you very much.
Thank you, Op 3, for that speech. And this marks the end of substantive speeches. I will invite Op reply to conclude Op case.
Hi, just checking that I'm audible and visible again.
Yes to both.
Great. Time starts in 3, 2, and 1. At the end of this debate, it's clear that proposition has still not given us a single substantive as to why their side triumphs in this debate. Proposition defends a world in which they defend the monopolistic control of the rich, where they control the world, where they control the rich, the middle class, and the poor. And they say, they close their eyes to it. They bat their eyes at it. They say, oh, it's fine. Let's allow the middle class to suffer. Let's not help them. Let's not give them this guy, like this lending hand, this saving line to actually go and invest. 3 things today. 1, principle. 2, the practical debate. And 3rd, where the delta of this debate actually lies. But before that, a simple call out. There's a blatant shift in the case strategy and their pathway from first and second. Because in first, they say that, oh, we're going to defend institutional trading, right? But when Rico came up here and proved to you why principally and practically that retail trading is viable and it's going to be successful and why it's good for these people, they go ahead and shift their entire case thing, right? They in second, they didn't come up and tell you that, oh no, that's wrong. That's not the counterfactual we're defending. Well, we're defending saving. But when we came up in second and we told you why saving doesn't work because it's going to be eaten up away by inflation and economic crisis, drop this and accuse us of cherry picking. How convenient, right? They're left with now counterfactual. But don't let them fix this in reply because it's too late. They didn't do this throughout 3 entire speeches. Then, on principle, we told you that the rich control the world because only the elite have access to stock trading. We told you that the comparative is that we're going to be giving them agency and autonomy for the middle class so they can break this barrier because otherwise they're going to be eaten away by capitalistic society and they're going to be like inflation and stuff like that. And they're also going to be subject to the things like misuse as funds. That's why accessibility in and of itself triumphs. And we take this debate on principle because we tell you that we are going to help the middle class. We're going to let them break this barrier. We're not going to make stock trading only available to the elite and the rich. We're going to allow the average Joes to rise up and actually succeed in life, right? So we take this debate on principle. Plus, they don't even give us a single response to that throughout these 3 speeches. So I guess they completely agree with our principle. Secondly, then, on practical, we told you 1, there's financial literacy because 1, there's going to be a lot of online discourse at the point at which this becomes a trend and a cultural phenomenon, and 2, that they're also going to do this based on personal experience, and that's literally just how people learn, right? They make mistakes and they make better decisions in the future. So I don't see why they keep hounding down on education and why it doesn't work 100% of the time. That's simply a fact of life. You're going to keep making mistakes and you're going to keep learning and then you're going to keep becoming smarter. Then we told you why the short-termism of institutional trading makes sure that these people cannot succeed and they're going to be put on the back burner. And we told you why you can then become more long-term and you can diversify your risk and hedge out your bets on different types of things when now you have the autonomy to do so. That's why you're able to succeed. But then, thirdly, finally, on the delta of this debate, let's just make it clear, all right? We've told from the start that the delta doesn't lie within the low economic strata that proposition keeps trying to talk about. It's not poor people that are going to be the actors in this debate because they don't even have enough money to put in into the stock trading, and they don't even have enough money to go to their other counterfactual, which is the same, right? They don't have the excess money that or the secondary income streams that the middle class does. That's why the delta of this debate lies within the middle class. That's why that's who we should care about, right? That's why we give them the financial literacy to be able to do this through the trend that so that there's online discourse and that they can learn from it. We tell them that no, stock trading is not only for the elite, it's for the middle class as well. You can go ahead and break the barrier. It is for these reasons that we are so proud to propose and oppose.
Thanks, Op reply. I'll invite the prop reply to conclude the case of government.
Hi, so sorry, but our reply speaker is still washing his hands. Okay, you know what, never mind, he's here. He will be starting right now.
Easy.
Apologies, ladies and gentlemen, I was in the washroom. Okay, give me a second. Clearly visible and audible, am I right?
Yes.
Alrighty, great. It seems like in today's debate, side opposition jumped the ship to our side, but missed the ship and fell down into the sea. I hope you're learning financial literacy from SpongeBob SquarePants. Now, let's take a look at the three counterfactuals that somehow existed in today's debate. One is the opposition's counterfactual. If the rich invest and you're poor, or you're middle class, or you don't have financial education, you educate yourself and you invest at your own risk. The second counterfactual is we rely entirely on institutional investing. Three, the actual counterfactual that we ran, what you know or what you think doesn't matter, whether you are middle class or whether you're a poor community. If you don't know how to invest, you do not invest. It seems like their entire team has not dealt with our case at all, has not dealt with a fundamental logic of our essential counterfactual at all. And from an objective standpoint, they completely lose this debate because of that. But that being said, let's indulge ourselves in more strategic errors the opposition made. First and foremost, they contradicted themselves in their third speaker very gracefully when we POI'd them about essentially letting these individuals take risks with their limited financial knowledge, and their side essentially said, these vulnerable individuals are not important. To quote her, that is what your side is making the debate about. Then proceeds to say 5 seconds later, the side that wins the debate is the team that protects the vulnerable the most. Clearly, she already conceded that the only team who talked about the vulnerable today, the poor individuals, and if by a stretch, the day-to-day workers who do not know how to invest, was our team. And therefore, we take this debate. Thank you very much. Next, we take another idea about this dropping of our substantives. They completely refused to deal with our second and our third substantive. No response was heard about the idea of saving. That essentially not investing, not retail investing, promotes saving by keeping your money safe in your bank account for future usage. In Singapore, this would be through mechanisms like CPF so that you'll be able to use it for your long-term healthcare and finance when you grow older and you don't have an income during retirement. That's what we're trying to protect. Meanwhile, on their side, what they're trying to essentially do is that, oh, you can invest all of your money away when you're young, you live while you're young, and then you ultimately end up with no money because you don't have the financial literacy to deal with in a very volatile market. You lose, that's not our problem, cry about it. So they did not deal with us at all. And we already gave you the additional analysis. But why does it affect poor people even more? Because they don't have the financial blanket, the safety blanket for them to have at least a sort of financial security that they'll be able to continue with this. And we gave you analysis on why these poor individuals would be willing to invest in retail investing because of, number one, societal pressure, and number two, them knowing that they will never be able to break out of their poverty cycle if they are in this day-to-day jobs, and therefore they need to return to drastic measures, often unique and new novel measures like retail investing now, to try and make a gamble and win it. It's like gambling, but with Manchester United. You always lose. I'm a United fan. Lastly, let's take a look at another idea about the accusing us of a lack of explanation for why there's an upward trend, and then tells us that those who don't have the money or time will not invest. First and foremost, we gave you the stuck mechanism of how a day-to-day individual's life is like. You go to work, you come back about 8 p.m., 9 p.m., you go and log on to your exchange at 10 p.m. because that's when the world wakes up on the other side of the planet. And then you're going to invest somehow without any much financial knowledge. That these people already don't have the time, but they do so because of, again, societal pressure. So therefore, they lose this. So on a completely terrible case, worst case for us, these people do not invest at all. They at least save their money and they have something secure for their long term. On their side, you can waste it all away and boom, you have no money left. Thank you.
Thank you, Prop Reply, for that speech. And thanks to everyone to what was a great debate. It was really nice to watch. I do hope you guys fix your relationships and all that. Actions, everyone. It was great. This is a silent round, so you guys can leave. My panel and I will remain on the call. We will be available for feedback though tomorrow after the break has been announced. So you can just remember our names and yeah, we will give you the feedback.
Sorry, Judge, just one quick question.
Yes.
Since this is a silent round, doesn't mean there will be no round 5 tomorrow.
There will be round 5 tomorrow.
Sorry, there will or won't?
There will be round 5 tomorrow.
Well, but round 5 results will be announced, correct?
Yes, correct.
Okay then. Thanks very much.
Easy. Thank you, guys.
Thank you for the debate.
Thank you for the debate.
Thank you.
Thank you. Thank you for the debate.
Thank you. Leaving. Goodbye.
Have a nice day.
Good night.
Can all speakers leave, please? Okay, panel, let's join room 45. I think it's faster that way. Panel, let's join room 45.
Okay.
Okay.